You deposit $1,000 into your bank account. You think it just sits there, safe, waiting for you. But the second that deposit clears, it's not just your money anymore. The bank starts using it, and how they use it makes them billions. To understand how this works, we need to look at something called fractional reserve banking. When you deposit that $1,000 into your account, the bank doesn't just lock it away and wait for you to come back. They're only required to keep a fraction of that deposit in reserve. The rest, they can lend out to whoever they want. Your $1,000, they keep a small portion. Then they lend most of it to someone taking out a car loan, a mortgage, or using a credit card. That borrower pays interest. And that's where it begins to shift. In your account, you might be earning 1% interest, but the bank, they could be charging 6%, 12%, even 20% on your money that they've lent out. They give you a small slice, then they keep the difference. That difference is called the spread, and the spread is the core of how banks make money. Let's simplify it. You deposit $1,000. You then earn 1% on it, that's $10 per year. The bank lends out most of that same $1,000. At 10% on it, that's $100 per year. Same money, very different outcome. That difference doesn't disappear, it becomes a profit. Now multiply that by millions of customers, and you start to see the scale. Credit cards are where this becomes most obvious. A credit card might charge 18% or 24% interest, but it doesn't feel expensive when you're only required to make the minimum payment. That's intentional. Minimum payments stretch debt out over years. Interest compounds, balances shrink slowly, and the bank earns consistently. Not because they took your money illegally, but because the system is mathematically tilted in their favor. Now zoom out even further. When banks issue loans, they aren't just moving existing money around. In many cases, lending effectively creates new money in the system. New deposits appear when loans are issued. This increases the overall money supply. More money circulating in the economy can contribute to rising prices over time, and when prices rise, the purchasing power of your savings falls. So even if your balance number stays the same, what it can buy gradually decreases, which means your money can lose value quietly. So when people say it feels like banks are taking a cut, this is usually what they're sensing. You work for money, you store it in a system, and that system uses your money to generate returns far larger than what you receive. Capital earns more efficiently than labor, and the structure is built to reward that. That doesn't mean banks are evil. It means they're businesses, and businesses are optimized to generate profit. The important question isn't whether banks make money from your deposits. They do. The real question is whether you understand how the system works, because once you understand it, you can change how you interact with it. Avoid high-interest debt first, pay attention to fees, and don't rely on minimum payments. And if your money is going to sit somewhere, consider whether it's working hard enough for you.